In this session, we are going to discuss how firms estimate cost of common stock using CAPM models. This is capital asset pricing models. And we also explore two keys way the firm raise common equity and the hidden cost of the retained earnings. So first, the firm can raise common equity in actually two ways. One is by issuing new shares. And second way is by retaining earnings, which means reinvesting profit instead of distributing them as the dividends. So some might think that retained earnings are free since now no new stock issued, right? But that's not true. So retained earnings impose an opportunity cost on shareholders. So why? Because shareholders could have received those earnings as dividend or buyback and reinvested them anywhere else in securities or any financial asset of the similar risk. So how do we determine the cost of using retained earnings? So since stockholders expect to earn the return, which we call RS, so on investment of equivalent risk, the firm must also generate at least RS on reinvested earnings. So if a firm cannot earn at least RS, probably it would be the better of distributing earnings to shareholders as dividends. So let's look at how firm estimate the cost of a common stock using CAPM. So estimating required rate of return using CAPM part. Okay, so capital asset pricing model help us estimate the required rate of return of the stock. So CAPM consider risk-free rate, market risk premium, and stock's risk level measured by beta. So how we can estimate the required rate of return using the CAPM? First step is estimating risk-free rate, or RRF. So this rate represents the return on the risk-free investment, typically based on U.S. Treasury bonds. Since Treasury bonds are backed by the government, so they are considered usually risk-free. So most common used benchmark is the yield on 10-year Treasury bond. So next, we estimate market risk premium. So this is additional return investor require for taking on the risk of investing in stock over risk-free asset. So we can measure this market risk premium by subtracting risk-free rate from expected return on over stock market. And step 3 is estimating stock's beta. So now we need to determine stock beta. The beta measures how much risk the stock add to diversified portfolio. So the beta of 1 means the stock move in a range with the market. So the beta greater than 1 means that the stock is more volatile than the market, and beta less than 1 means it's less volatile. So finally, we plug this value into the CAPM formula to estimate the stock required rate of returns. So let's talk about estimated risk-free rate and key component of capital asset pricing models. So since no investment is truly risk-free, so we use treasury bond yield as practical estimate. So why treasury bonds? So treasury bonds are considered the safest investment because they are backed by U.S. government, which has an extremely low likelihood of default. So this makes them the best available proxy for the risk-free asset. So most analysts or the firm use the yield on 10 years treasury bond as a risk-free rate. However, some also consider 20 years or 30-year treasury bonds. The key is match investment horizon, since start a long-term investment. So using long-term treasury yield makes sense. But why does this matter? So actually, the risk-free rate affects the entire CAPM calculation. The lower risk-free rate results in lower estimated cost of equity, while high risk-free rate increase the required rate of return investors demand. So now let's dive into the estimating the market risk premium and beta, and two crucial factors in measure cost of common equity using CAPM. So there are three common ways to estimate market risk premium, which represent the extra return investor required to invest in STAR over the risk-free asset. So historical average. So we analyze past stock market return relative to risk-free rate to measure average premium. So for example, from 1960 to 2022, historical risk premium average about 5.6%. Second way is expert survey. So financial expert, the CFO, and analysts provide their expectation. Or 2022, the Duke University and CFO magazine survey estimate that kind of a market risk premium of 5.9%. So forward-looking estimates. So using dividend yield and expected growth rate, we estimate expected return on the market and subtract this risk-free rate to get forward-looking premium. Okay, so next we need to determine stock beta, so which measure how much risk the stock add to the diversified portfolio. So the beta of the 1 means the stock move in a range with the market, and greater than 1 means the stock is more high volatility, and while beta below 1 means the less volatility. So for example, let's assume in our textbook example, microdrive beta is 1.33. So this suggests microdrive stock is 33% more volatile than the market. Okay, now let's discuss another widely used method to estimate the cost of common equity. We call this is dividend growth approach. So this approach is also known as the dividend capitalization model, or dividend yield plus growth rate approach, or DCF approach, discounted cash flow approach. So the idea behind this method is simple. The required return on the stock should be equal to sum of these two components. So first component is expected dividend yield. Second component is growth rate. So the expected dividend yield represents the cash return investors receive from their dividend. The constant growth rate of dividend reflects the expected long-term appreciation in their stock value. So in the green box in here, right? So the formula is derived from the Gordon growth model, which assumes the stock value is based on present value of futures dividend and growing at the constant rate. So why this model is useful, but it does comes with some key assumption and challenges. So constant dividend growth. So it assumes the dividend grow at the stable rate forever, which may not always be realistic. Many firms have fluctuating their growth rate. Also, this model only applies to dividend paying firm. So which exclude may fast growing tech company that reinvested profit instead of paying dividend. And in addition, the cost of equity is highly sensitive to assumed growth rate. So if we overestimate G, we underestimate RS, leading to poor investment decision. So these models assume the current stock price correctly reflect firm's value and futures growth perspective as well. So unlike CAPM, which consider systematic risk and beta, CAPM use and consider beta and the systematic risk. The dividend growth model focuses solely on the firm's dividend policy and their growth expectations. So while CAPM is useful for all stocks, DDM model is either for stable, mature firm that consistently pays dividend. Okay, so let's using when using the dividend growth approach to estimate the cost of equity, one of the biggest challenges is determined the G, growth rate. So this growth rate is play crucial role in the calculation, and different method can be used to estimate the G and growth rate. So first, one common method is using historical growth rate, which analyze past earning and dividend growth to predict future growth. So this involves looking at firm's historical financial statement to determine how dividend or earnings have grown over time. So for instance, if the firm dividend have grown an average rate of 5% a year, and we might assume this trend will continue and use as G is 5% in our formula. But there is a sketch, historical growth rate are only reliable under specific condition. So first is they work best for mature and stable firms that have long track record of the constant in the dividend payment. So they are less useful for new or high growth firm where the dividend and earning is fluctuated significantly, or past growth does not guarantee future growth, right? So especially if industry condition and market strategies change. So more forward-looking way to estimate the growth is retention growth model, also known as sustainable growth rate models. So this way assume the firm grow by investing its earning rather than paying them all out of dividends. So the formula for estimated growth rate is G equal ROE times the growth rate. So this growth rate is usually 1 minus the payout ratio. Okay, so payout ratio is actually dividend divided by net income. So the dividends per share divided by earning per share is net income per share. So just payout ratio is DPS, dividend per share, divided by EPS, earning per share. In addition, retention ratio is actually addition to retained earning over net income. So addition to retained earning actually equal to net income minus dividends. So 1 minus dividend per share divided by earning per share, actually this is 1 minus payout ratio. This is equal to retention ratio. So it means retention ratio plus payout ratio always equal to the 1. So GL actually ROE times retention ratio. So ROE times 1 minus payout ratio is actually the growth rate. So the retention growth model links growth directly to firms' profitability and reinvestment decision. So it is useful for firm that reinvest a significant portion of their earning rather than paying a high dividend. But however, it assumes very stable ROE, which might not always hold true. In addition, it also ignores external growth factors such as industry expansion, economic condition, and mergers.